So in this video, I wanted to talk about asset allocation for Canadians. Basically, this is the first thing you should be figuring out as an investor, and probably one of the most difficult things to figure out as an investor. So this is really InvestCan's primary job. How do I build a portfolio that's diversified, and how do I pick an ETF for each asset class? So after reading a bunch of books in 2011, what I came up with at that point in time was every investor should have a target date fund, and every investor should be able to handle a two-fund portfolio. Basically, this is like your 72 to 28 split. 72% stocks, 28% bonds. Like every person on this planet should be able to handle a quick little ratio like that. Now, the trickiest part of this strategy would be the target date part. Like, what is a target date fund? So basically, this is an investment product that you only have to buy once. You literally don't have to trade your ETFs. You don't have to buy, sell, do anything. You just keep buying this product for the rest of your life. It will help you rebalance your money over the years and help you fight the sequence of returns risk. This is why it takes stocks out of your portfolio as you get older. Buying XWD for your global equities and HAF for your global bonds has beat every asset allocation mutual fund at any financial institution. So your stocks are in green, this is your offense, and your bonds are in gray, this is your defense. So basically that seemed too simple. Two funds to beat every mutual fund? That sounds crazy, but it is true still to this day. So if you look into mutual funds, you can actually see exactly how they're constructed. So after looking through all the different mutual funds, you can see, okay, they have a bit of bonds and then they split out their equities. So in 2017, I launched iPiggy. This was on the App Store for a few months in 2017. Basically, I'm just going to use 5 funds and split up the equity part of the portfolio with the 4 different asset classes Canadian investors have access to. So you can build this 5-fund portfolio simply with ZEM for your emerging markets, XEF for international, VFV for your American, XIU for your Canadian, and ZAG for your aggregate bond. And there's so many different ETFs that you can buy in each category, and that's the foundation of InvestCan's advice. Basically, it's finding you the best asset allocation. It doesn't matter which ETF you buy in each asset class, it just matters that you buy the correct percentage. This is your diversification. This is making sure your money's spread out so you don't just own Canadian bank stocks. So 2022 came around and I launched InvestCan. I left the industry as a registered advisor because I could not sell this product while being one. And basically the template this time around was changed just slightly, spreading out the bonds a little better. So basically all I did in the equity part of the portfolio was split up the American to a NASDAQ and a New York Stock Exchange. So basically there isn't really a New York Stock Exchange ETF, so VFV is an S&P 500 and HXQ is the NASDAQ. Basically, splitting up the fixed income to be more in control was also in investors' best interest. Choosing how much of each bond is in each of the fixed income asset classes. Also adding gold as an extra diversifier. So 2023 rolls around and I say, all right, DIY investors, tell me what's wrong with this product. I have absolutely no bias. I'm using math to calculate every portfolio possible. Basically, I'm adding the best risk-adjusted return to an ETF. Tell me what's wrong with the portfolio. So basically the most common concern, complaint, whatever you want to call it, was I was only using one ETF. People wanted more than one ETF in their portfolio. Why I chose to use the US sector and commodity, basically this allows absolutely no bias whatsoever. Every single ETF that is available for sale is in the algorithm, and basically it has a category. And it's just putting the best recommendation forward, how to make the most amount of money with the least amount of risk. So when you're using the app, basically when you click one of these pie charts, basically your purple here is showing, hey, this is American equities. If you're 72% stocks, 17.46% of your money should be in American equities. And these pie charts are kind of correlated up and down. When building a portfolio, one of the two American equity ETFs should be potentially QQC, and putting 9.25% in QQC is probably your best bet right now. So hopefully this video really explained to everyone why you split up your stocks and bonds and really look at them separately.